Most owners at your level do not have a tax knowledge problem. You have an implementation problem. You heard the strategies: entity structure, retirement plans, cost segregation, real estate appreciation, short-term rentals. You can explain some at dinner to your friends. But knowing the name of the strategy is not the same as having it on your tax return. Your tax return does not reflect what you heard. It reflects what you actually did, what you filed, what you funded, and what you documented, and what the facts can actually support. Filed correctly is not the same as planned correctly. A tax return can be accurate, yet miss the entire strategy. That is where the money quietly slips away. I am Miguel Palma, 30 years in tax advisory, trained at Deloitte PwC and PricewaterhouseCoopers. We work with business owners across the country, fully remote. If you're sitting across from me, I will not start by asking you what strategy you heard about. I will check to actually make sure that it made it onto your tax return, and whether you can prove it to the IRS if they came knocking. For number one, entity structure. This is usually where the first break happens. It's not because an LLC or an S-Corp is magic, because the structure determines what doors are open. If the S-Corp election was never filed, you do not have S-Corp treatment. If the S-Corp never pay you payroll, the IRS can challenge the distribution and reclassify them to wages. If nobody's tracking the basis, debt, wages, distribution, and documenting, the return will never tell an accurate story. You do not have planning, you have movement of money. And movement of money is not a tax strategy. The structure has to match how the business actually makes money, how you get paid, and how profit moves. It does not sit by itself. It connects to payroll, it connects to retirement, and it connects to your personal return. 2, retirement accounts. Most owners will say yes, but that question is too small. At your level, the real question is whether the plan was designed around your business. A 401k, sometimes a 401k profit sharing, sometimes a cash balance plan, sometimes a defined benefit plan, sometimes an HSA. Not every owner needs all of it, and not every business can support it, but the deduction is not created by wanting it. It depends on payroll, it depends on employee census, it depends on cash flow, it depends on the plan design and plan document, and it depends on funding before the deadline. That is why retirement planning done in April is usually too late. By then, the year is closed, payroll is done. The employee data and yours is fixed, and the best options may already be gone. So the question is not, did you contribute? The question is, was the plan designed before the year was closed? Number 3, real estate. This is where a lot of high earners get excited. Cost segregation can accelerate depreciation, and the law brought back 100% bonus depreciation on assets purchased and placed in service after July 19, 2025. That can create a large first-year write-off. But a large write-off is not the same as a lower tax bill. Here's the part that most people miss. With real estate losses, the IRS usually starts at no. For most long-term real estate, the starting point under Section 469 is passive. That means you do not get to deduct the big loss against your business income or W-2 income just because the property generated a huge loss. You have to prove that the loss qualifies to offset the income that you're trying to reduce. One path is the real estate professional route. That means more than 750 hours a year and more than half your working time in property real estate business and material participation in the rental. Short-term rentals can be different, but different does not mean automatic. You still need the facts, you still need the participation, and you still need the records. You must keep time logs. So the real question is not, can I get a cost segregation study? The real question is, if the study creates a loss, can I take that loss to offset my business income and W-2 income? That gets answered before you buy the property, not when the return is being prepared. Different strategies, same problem. An S-Corp has to be elected and run like one. A retirement plan has to be designed and funded. A real estate loss has to clear the tax rules. Each one comes down to 2 questions. Was it actually implemented? And can you prove it as someone asked? Skip either one, and it was just a great idea that was never implemented and could never generate the tax result. At your level, your return should not just record what happened. It should reflect decisions you made before the year closed. Entity, payroll, retirement, real estate, documentation. If those pieces are not connected, you do not have a plan. You have filing. If you're doing $1 to $10 million a year and you suspect that the strategies you know about never made it onto your return, there's a link in the description to book a free tax assessment. It will review where the gaps are and whether they're worth fixing before the year's tax return is locked in. No pressure, no BS, no sales pitch, just clarity. Remember, you got this.